So last week on Friday, we got a jobs number 232,000 on an expectation of actually 227,000 on an expectation of 200,000. Wages slowed down. Unemployment rate crashed to 3.5%. We got some negative pre-announcements from Macy's and from Constellation Brands. But will we have more? We got a layoff notice from Salesforce.com of 8,000 or 10%. Lots of stuff going on. We have earnings announcements starting next week on Friday from the big banks. Starts off Monday with Jeffrey Financials. But so much stuff going on. We bring on the one and only Mr. Dan Bird to talk about it all. How you doing, sir?
Doing well. How are you?
I'm doing well. So I think we got to start
I
with
was
Friday.
a little behind on the newsletter because I was at the VectorVest seminar for 2 days.
Yeah, I saw that. I just saw it came across. So I have not read it yet. It only
Yeah,
came 20 minutes
I
ago.
just literally just sent it.
Yeah. So that's all right. I know people look forward to it. So I'm sure we will digest it today. But why don't we talk about last week?
I had one guy send me an email saying, "Where's the newsletter?
Ah,
Why didn't you send it? Why didn't you send it yesterday?"
oh, that's funny. As people they become used to it. That's for sure.
Yeah, that's good. It's good to see people are reading it at least.
Yeah, exactly. So what did you see Friday? The jobs number came in higher than expected, which again at the surface may have sent the market lower, but really wages, right? The whole wage inflation spiral showed some retreat, I guess you would say.
Some weakening in
Yeah.
wages, right?
Weakening, that's a better word, yes.
Yeah, which is what the Fed's been looking for.
Yeah. So something I said today, I want to see if you might agree with or disagree with, as always. I've always thought the chances of a soft landing were unlikely, not impossible, but unlikely. Uh, After Friday, my odds went from like 2% to maybe 15%. I think their chances are going up of getting a soft landing because, again, it's kind of what they were looking for. But, I don't know what your thoughts are.
So, I'm pretty much the same as I've been saying all along. I think there's a potential for a soft landing. This is a rolling recession.
Yes, I
So
agree.
it's not, we have to make sure we keep that in mind because I'm not sure there's anybody around or unless, you're pretty old and been in the market for a long, long time
Right.
that have seen a rolling recession. The last three that we've had have been an all at once recession.
Agreed.
And that's what people are expecting when they hear recession. That's what they're thinking. Everything's going to go away or decline at the same time. And that's not what's going to happen this time.
No, I agree. I've been trying to bring in that rolling recession idea for at least 9 months. We saw it very specifically hit mortgage first, then realtors next, then auto. It's going to ripple through the economy. And the key to your point is the rolling recession at the aggregate may not be big enough to take the country negative, but it will be a slog until it's done.
Yes.
That's the
Yes,
key.
that's right. And different parts of the economy will feel it at different times as well.
Exactly.
I mean, usually the last domino to fall is wages and employment, and that's been hanging in there pretty darn well, actually. Um, I have a interesting chart that I put in my newsletter that I'll show here too.
Okay, let's see it.
But let me share my newsletter for anybody that's interested.
Yeah, this is a newsletter that lots of folks, I think almost 1,000 people on my channel get. It's free.
Just almost 1,000 that I have from your channel. It's
That's
starting
fine.
to slow down, so we may have reached
Yeah.
everybody. You need to add more to your channel.
Yeah,
Mike.
that's right. Exactly. I do. I'm trying.
or I need to do my own YouTube.
Yeah, there you go.
Or both. Anyway, if anybody would like to get it, just send me an email to breakpointtrading@gmail.com, and I'll send you last week's and put you on the list. This is kind of an example of an excerpt. This is what I'm going to talk about, this chart right here.
Okay.
But I put some cartoons in this week. I actually put 3 new book recommendations in this week from the VectorVest seminar that I went to. Right. So I got
best
3
loser wins. I don't think I've heard of
best
that.
loser wins. It's all about the psychology of trading, that most people would rather lose than be wrong.
I get it.
And most people that are not successful at trading, it's kind of counterintuitive, and it's something that takes a long time to learn, to figure out. Whenever they whenever they get a winner, they
Yeah.
first of all, they get burned by losers. Okay. So
Sure.
they're afraid of the losers.
Yep.
Whenever they get a winner, this is the way most people typically think. Whenever they get a winner, they sell it quickly to lock in the profits.
And then they hold the loser.
And they hold the losers because they are convinced that they're going to come back.
Yeah. And then they get back to even and they sell it. And then, yeah.
And they get below even.
Yeah. Right.
And then they say, well, it's too late now.
Mm-hmm.
Or even worse, they add to their losers.
Oh, they dollar cost average on the way down.
That's right. It goes down. They're like, oh, I'll buy more, and that will lower my basis, which it does.
Yeah.
But
that's funny.
That's a losing proposition. Then on the other side, the winners, the people that are successful, they cut their losers short very quickly without emotion.
Yeah.
And when they get a winner, if something starts going up and then it pulls back, instead of selling it to lock in the profits, they buy more.
Interesting.
So that's kind of what that book's about. Best loser wins.
Got to check that one out. And again, one of the things that you brought to my channel, we've been doing this a year now. Some of the early stuff, we talked about stop losses and all that, folks. Go back to Dan's playlist and check some of those early conversations, because that cartoon in the upper right, very, very true. That's something I did not do 20 years ago. Yep.
Right. Yeah. Oh, you always have to put in a stop loss. Think this was an interesting too. I haven't read it yet, but this is one by what's her name? Katie Duke. She's one of the world renowned poker players.
Yeah, that's what I thought she was. Yeah. Okay.
Right. So thinking in bets, making smarter decisions when you don't have all the facts.
I like it.
That one sounds pretty interesting. But this is the one that I wanted to talk about. This chart right here. I put this in the newsletter. Just out of curiosity, I went back to Fred to look up the unemployment rate going back to 1948. And that's the blue line, and then they put in the gray areas, which are the recessions.
Yep.
And then I annotated this. I put the 3.5% unemployment rate, which we just dropped to. Yep. As you said, we crashed, but I wouldn't characterize it as crashing, because it's actually a good. It's a good thing that
I was teasing. Yes.
Fewer people are unemployed.
Yes.
But you can see where the 3.5%. I put that line in. 3.5% is right there. It's very rarely. It almost never goes below it. Really, only once went below it back here in the 50s, and it rarely even comes down to it. Yeah. So we're right at the low, basically the lowest point.
Usually 50-year low. Yeah.
Yeah. But, and then I also annotated it with my famous secular bull and bear components. So, which I always do in long-term charts like this. Right now I know where they are, so I can visually imagine where the secular markets are. But I like drawing them in just to see what's happening.
Oh, the audience really appreciated it, and I do, because we don't have the same. We haven't looked at it so often we can visualize this, but it's very clear that unemployment bottoms at the beginning.
Unemployment bottoms at the end of a secular bull. The end of a secular bull. It bottoms, but it's coming. It's at its peak when the secular bull begins.
Correct. Yes.
And then it continues down, and during secular bears, that's when it's at its bottom. Secular bears begin, and then it just continually climbs throughout the secular bear market.
Yeah. So one of the things I know you've talked about many times is you still think this bull's got 8 to 10 years left to go. Does this chart change your opinion at all?
Not yet. It doesn't, but it potentially could. If this unemployment rate starts to really spike up really high, like if it gets over, let's say 5%, then we might then be in the bear range.
Okay. All right. Fair enough.
The other thing to notice is that the gray areas are recessions. So you can have recessions inside of a secular bull.
Oh, for sure.
But if you look at the secular bears, like this one here, there are 4 recessions in this.
Yeah, that would be the 70s and 80s, folks. Not a good time.
Right. And then the 2000 to 2009, there were 2 recessions. One was a pretty significant one,
Yeah.
2008. And then in the current secular bull, we just had this little tiny 2-month recession.
Yeah.
So that's the other thing to take away from this.
All right. Very cool.
So I thought that was interesting. Just for as a refresher, I showed this last week, but this is the current month. So we're now starting into week 2.
Mm-hmm.
We had a nice rally on Friday.
Yeah, 700 points in the Dow, I think.
Yeah, I'm going to talk about that. It's we are at a very, very, very critical point right now. But we're now in this week 2. That's when the CPI inflation report comes out Thursday.
Yeah.
We'll talk about that a little bit more in the second session.
Yeah, I'll just say it here. Expectations are 6.6.
6.5.
Oh, 6.5. Oh, 6.5. Oh my goodness.
Yeah, expectations are 6.5 right now.
Okay.
In fact, let me look over here. This is actually my newsletter right here. So here's last week's economic calendar. You can see non-farm payrolls 223. Forecast was 200. So that was better than forecast.
Yep.
Interestingly, the manufacturing numbers, the PMI, came in lower, under 50.
Yeah, 49.6. I talked about that today. Yeah, that's a contraction.
That's contraction. Now remember, a rolling recession.
Exactly.
Right. So we're getting contraction in manufacturing. We're getting improvement in GDP, and we're getting improvement still in payrolls. But manufacturing is starting to contract.
Yep.
So we'll see how long that goes. And it's interesting to watch these numbers, because this is a really good example of that rolling recession idea. So here's next week. Thursday, big day Thursday. Expectation for CPI is 6.5. Wow. Last time it was 7.1, so it went from 7.7 to 7.1. If it comes in at 6.5, then that's another 0.6 reduction. So 0.6 down the last time, potentially 0.6 down this time, although I don't think it's going to be.
Yeah, that's a hell of a drop.
We'll talk about that in the next session.
Okay.
And then the earnings for next week. Here's Jefferies that you mentioned on Monday.
Yeah. And
then you see Friday, this is when earnings really get started. You got Citigroup, BlackRock, Bank of America, Bank of New York's,
JP Morgan,
Wells Fargo,
yep.
United Healthcare. So a bunch of banks are reporting on Friday.
Yeah, I'm going to look at Jefferies to see if it gives me any sign to what may happen with the big banks. That'll be interesting.
Yeah, right.
KB Homes is a big one for me on Wednesday. KB Homes.
Right. Yeah.
Kind of that first time buyer. That's one I'm watching as a housing channel.
Okay, good. And what are the ones in here? Taiwan Semi, that might be an important one on Thursday. Sure. Bed Bath & Beyond will be interesting to see what happens there.
Oh yeah, they just issued a notice of concern, so they're running out of cash.
Yeah. I wouldn't be surprised to see them go bankrupt. So I talked about this one. So here's my secular bull chart. This is the one that I'll know when we're done with a secular bull and we're now starting into a secular bear.
Okay.
This is a monthly chart. So the top one is the RSI. You can see here, this is where the bull started. Actually, it started either 2009 or 2013. This little blue arrow right here, you see this parallel line?
Yeah, it broke the top, yeah.
Yeah, this is the S&P down here. So that's where it broke out. So all through this period from 2000 until 2013, it never broke above this line. This was a secular bear market back here. The bottom was actually 2009. So you potentially could start the count from 2009.
Okay.
Or start it from where it actually broke out, because potentially it could have gone up here and gone right back down again, right?
Sure.
Then it would have still been in a secular bear market. So either of those, but 2013, secular bulls usually run 18 to 20 years. So if you started from 2009, 20 years puts it at exactly the anniversary of the 1929 market crash.
Oh, great.
2029.
Oh,
But so
joy.
but so far, none of these have gone below the key levels.
Okay.
RSI, the PPO, which is a momentum indicator, that hasn't gone below 0, and this one here has not gone below the 200-week moving average. That's this red line. You can see all the way through here. Sometimes it came down to it.
Right.
It went below it for the COVID crash, but never closed below it.
Hmm.
So it actually came down to it again in October at that low, the low of October, and bounced right back up.
Okay.
So keeping that in mind, let's look at this chart. I spent quite a bit of time in the newsletter on this, trying to explain it, trying to help people understand what this is saying. Okay. See if I can even make it bigger than this. There we go. All right, so this is the chart all the way back to October of last year, but you can clearly see this whole year, which is, you know, right here, 2022. This is January. That was the high. This whole year, when we hit that high, we came up and hit this high, and then what started back down again. That's when I drew this line.
Right.
Right. Connecting these two tops. Then the market went down in June to what Tom Bowley thought would be the low, and went right back up and not only hit the line exactly. Now remember, the line was already drawn in, and it just happened to coincide with a 200-day moving average right there. Got rejected again, went down to a new low in October. Then it came back up and hit that line almost exactly, and also again was right about where the 200-day moving average was.
Yep.
And got rejected again. All right, so that's point number one. We need to get above that line.
Okay.
Point number two. And I drew this shaded area here is the gap from back in November.
Right.
Where the market gapped up and started going higher right here. And I said back then, back in this area somewhere, I said there's an open gap down here, and I wouldn't be surprised if the market goes back down and fills it.
Yeah, we have receipts. Your playlist has that. I think that was like 3 weeks ago.
Right. Yeah. Actually, I think it was even more than that.
Might have been, yeah.
Because the last 2 weeks it's just been going sideways, but look where it's going sideways.
Yeah, filling in the gap.
Right at that gap. All right. The third point to notice is these key moving averages here. This is something that I learned this weekend from a guy named Dr. David Paul, who has been trading for years and years. He's trained traders how to trade. He got up at 3 different talks. Fascinating stuff. But he said he uses is the 21-day, the 55-day, the 89-day, and the 200-day moving averages. Those are the ones he puts. Now, I always use the 21 and the 50 because 50 is what most traders look at. And I use the 200, but I never included the 89.
Right.
But the 89 now is in here in this purple dotted line.
Okay. And
the 55, by the way, all of those 3 are Fibonacci numbers.
Of course.
That's why he uses those. 21, 55, and 89 are Fibonacci numbers.
Got it. Makes sense.
All right. So what you'll notice, and what he likes to do is to trade when these all cross. He calls it a bow tie. So they all crossed right here. 21 crossed the 50 and the 50 crossed the 89 right here. Okay. But that happened to be the exact high.
Right.
And like I've always said, you can't use just one indicator. You have to be looking at a confluence of signals. Okay. So at that particular time, the RSI was in overbought territory, meaning it was ready to go down. And the PPO up here was also crossing over to go back to the downside. So, and it was hitting the 200-day moving average.
Right.
So even though these 3 crossed here, everything else was saying don't buy yet. But look at where they are right now. They are all, setting up right here together.
Okay. What does that mean?
And on Friday, we closed above all of them. All right. So that's the third point.
Okay.
Point number 4. And I explain all this in the newsletter,
Yeah.
but there's a lot to it. There's a lot happening in the chart right now.
Okay.
So point number 4 is I drew 2 Fibonacci levels on this. First one is the pink line. If I'm not going to get into Fibonacci, but people can go Google it, try to understand. Fibonacci was a mathematician back in the, I think, the 15th century, who discovered that there were certain numbers in nature that repeated over and over again. Things like the way flowers bloom and marks on trees and things like that. So this is based on Fibonacci levels, which just so happens is what a lot of traders watch, and that's why it works. I'm not saying it works because God somehow ordained these numbers as magical numbers. So because they're magically ordained by God, that's why the market stops when it hits them.
Right.
No, it stops when it hits them because everyone else is looking at the same thing.
Yeah, of course. Yeah.
That's why. So anyway, I drew the anchors at the top of this first time that it hit the 200-day moving average up here.
Okay.
And the bottom in October. And then I drew another Fibonacci, which is the gray ones back over here, which also used the low of October, but it used the high up here of the year.
Okay.
Just 48.18 up here, right there. You can't really see it, but it's right there. That's the high.
I see it. Yep.
That's the high of the year. And then I wanted to see where these two coincided, where they met.
Yeah.
And the first place they met was right here. You see the gray one, the 38.2 level is at 39.98. And the pink one, the 61.8 level is at 39.91.
Yep. Okay.
See that?
Yeah, I do.
You follow that over, look where it is.
Ah, okay.
Right
Within
there.
100 points. Yeah.
Right at that downtrend line and right at the 200-day moving average. Almost perfectly.
Wow. All
right.
Okay.
So the next place where they coincide is up here. The 61.8 for the gray one is at 43.11. And the top right here is 4,300. So, but you could just say 4,300, right?
Okay. Yep.
So 4,300 is the next really important level. Now, and then you can look at the momentum indicators. You can see the PPO is starting to turn up here. And the RSI did not go below 40. And that's starting to turn up. So momentum is starting to go back up again. We don't know yet, but we could have the first higher high of this whole downtrend. This could be the first, the first higher low, but we don't know if it's a higher low until we get a higher high.
Right.
And in order to get a higher high, we have to be above this high.
Okay.
Which just happens to be right
at that
up
number,
in this area. All right. So of everything that I have taught everyone so far about technical analysis, where do you think, for all the people that have been short and are still short and are still convinced that this market is going down, where do you think they all have their stops to cover their shorts if they're wrong? Where do you think that would be?
4,000? Thereabouts?
Yeah, right. Or just above 4,000.
Yeah.
And maybe just above 4,100 because that was the old top. But somewhere up in here,
right,
there's a whole bunch of stops sitting there.
Yeah.
And those are buy stops. They're not sell stops.
When buy stops, exactly.
A whole bunch of buy stops sitting right up in here. Because there are so many technical trading identifiers all coming together right here in this area. Right? So I've just explained them all of why this is so important right here.
Yep.
If the market does go up, and Monday is really important because we need to have confirmation to know if this rally is real or not.
Yeah, it really what Friday's rally was for me was people were thinking the Fed's winning, they have to raise less, they're beating back wage inflation. 10-year Treasury crashed, right? 10-year Treasury went down like 15 basis points or something wild.
Right. Yeah, you can see that on this one.
Yeah, look at that, just big straight down.
Yeah. So there's the 10-year Treasury. It's almost back to 3.5 again.
Yeah. Which
is where it was back here. If it goes, and that's actually the trend line. You know, it's right at the trend line.
Mhm.
This line right here. If I can get it. Yeah. There's the trend line right there. So it's right at that trend line that goes way, way back here.
Yeah.
If it
Yeah.
goes below that, that's going to be great for growth stocks.
Yeah, absolutely. Next week's important. For me, it all boils down.
Monday's important.
Monday's important. Sorry. Excuse
We
me.
need to see if we get confirmation. You know,
Yeah.
the VIX is still, acting weird.
Yeah, it's still way low.
It's low, and it did start to go down, which it should have on Friday because we had a rally, but it didn't really crash.
Right.
Not yet, anyway. I mean, there's really no lime green color in here, just a little barely little tiny piece of one right there.
Yeah.
Not like it was right here when the market was going up.
Right.
So,
yeah, Monday's going to be fun.
Monday is really super, super important to see what this market is really going to do.
The other thing that I think we should just close this on that's going to happen next week that's outside the charts is perhaps negative earnings pre-announcements.
Right.
We got a couple Macy's retailer, Constellation Brands. Salesforce said they were going to lay off 10%. As an accountant, right? That was my first job out of college, and I was a general ledger accountant. We would prepare the books, which would have happened last week. We probably would have given them to executives on Friday. And next week, we may see some pre-announcements like, hey, quarter wasn't what we thought. Let's kitchen sink this thing.
Right.
I don't know. It could be interesting.
Yes, it could be. It could also be an upside surprise.
Oh, it could be. I mean, that's why I'm looking at Jeffries starting on Monday, right? Is Jeffries going to come out and say, oh, all's good. Savings are up. No reserves for bad debt. I mean, it's a wild time to watch. I mean, the market is certainly, I think the market is set up is set up negative. So any positive news, it just could be a powder keg. Back to your shorts being cashed out at 4,000 or whatever.
Yeah, between 4,000 and 4,100.
It's just a powder keg of shorts.
If we get over, so this is a weekly chart here. One thing I want to point out is each one of these last three candles, the first two are red, the last one is white. Can you see those there?
I can.
But look at the tails on each of them. You see the little tail on the bottom of those candles?
I do.
So what do you think, from what I've taught you, what do you think that means?
Well, it closed higher than the lows. So probably retail trading came in early, blew out, and then the professional buyers came in.
Yeah, that's a good way to look at it. Basically, by the end, and this is a weekly, so by the end of the week, even though it dropped and went down to the lows, buying came in.
Right.
Buying came in and pushed it back up in all three of the last 3 weeks.
Yeah.
And remember when I showed you this chart here, basically the last 3 weeks have been hovering around this gap right here. All right. So on a daily chart, you look at the last 3 weeks and it looks like this.
Yeah.
Looks like just a mess of congestion, right? Right there. But if you look at a weekly chart, this really tells the story.
Yeah, it's a cleaner picture. Yeah.
All the big players are buying at the end. They're accumulating. They're positioning for a rally. They're accumulating off the backs of the retail traders who are selling out right in through here.
Yeah.
All right. So keep that in mind as well.
Okay.
Yeah, I thought there was one. Oh, yeah. When it gets up above this 4,100, like I said, there's a lot of buy stops sitting in here. But if it gets up above that 4,100, then we will have confirmed a higher low.
Right.
And that's the first step of an extended rally.
Okay.
If we get above 4,100 and close above there, then this rally could last a couple of months, 2 or 3 months.
Okay. I like it. Well, do me a favor, show your newsletter one more time, and we will go to episode number 2 where we will talk CPI.
By the way, I explain all of this in my newsletter. I try to put this in as much detail as I could, and it took quite a while to do this. because there's a lot of things happening in this chart right now
Sure.
that will come to fruition next week.
Nice.
So yeah, if you want my newsletter, just send me an email to breakpointtrading@gmail.com.
Awesome.
And I'll add you to the list and watch what happens on Monday.
There you go. I look forward to it.
By
Thanks,
the
Buck.
way, it could get rejected. Everything's right at a resistance level right now.
Right.
So it could just as easily get rejected and we go right back down and make another low.
I
So
will be watching Monday.
That's possible too.
Thank you, buddy.
All right. Take care.